Jacob, your flagship global fund, the Antipodes Global Fund, has outperformed its benchmark since inception. For a little while, it lagged the benchmark, and again over the course of this year, you're outperforming again. Leading into 2020, it has been hard for value-conscious investors to keep up with a market that rewarded companies that are growing revenue rapidly, but not necessarily profitability. Can you touch on what's driven your outperformance this year? Perhaps what you found challenging about the investment climate leading into February 2020, and how likely it is that we are witnessing the birth of a new bull market?
Yeah, look, they're good observations. I might start with the middle one and really just the environment of 2019, as you point out. It was those companies with good top line growth that outperformed. Generally, what we describe as the great, we at Antipodes at least we call it the duration bubble. Long investors looking at longer duration assets. Now that doesn't really talk to what the nature of the business is. It's this concept that when real rates collapse to zero or below zero, investors are willing to pay a higher price for those companies that have their cash flow further in the future. And they tend to become much more sensitive, or they become the outperformers. And that's certainly gone to an extreme when we look at all the quantitative measures of what the market's paying for. Let's call it high growth versus low growth, or high valuation versus low valuation. You are getting to sort of generational type extremes. So we think it's a function of low real rates, and which are a reflection of maybe a lower growth environment. And there's, we can go into sort of lots of underlying reasons for that, but probably it's a question of how long does that last. And then in the beginning of this year, we had a very different type of let's call it crisis, more of a health crisis, and it really leading to a very correlated sell-off in the market. So investors, the first thing they do when they start to see the economy being shut down is ultimately, is sell everything. So growth, value, quality, high quality, low quality, didn't really matter what style, what sector, what region. The initial response was sell everything. And the Antipodes Global Fund, we had some downside, we had some protection in place in terms of shorts on, and the cyclical shorts, especially anything related to aerospace or industrial cyclicals, those shorts paid off well. Also, we will short businesses with relatively weak balance sheets. As we describe it, multiple ways of losing. One of those ways is just weaker financial. Weaker companies in weaker financial positions. And so those two clusters of shorts paid off handsomely. We had some credit protection as well, because we are concerned about the longer term sustainability of corporate credit. We're an equity investor, but when you buy an equity, there's also always the business, your exposure to how a business is being financed is a critical part of that assessment. And we're genuinely concerned by some of the behavior in the past, since the financial crisis, in terms of companies that have geared up to do buybacks and taken on a lot of leverage in industries which are under disruptive pressures from some of the large tech companies. And then finally, in the long book, our long investments, look, it's been let's call it the defensive part of the portfolio that gave us the most protection. So we have a cluster of pharmaceutical stocks as being the cheap defensives in a world where defensives are generally very expensive. That arguably they are the cheapest part of that market. And we think there's good idiosyncratic reasons to own them, i.e. we don't think they're as bad. Like, these are stocks, you can buy Merck or Roche, relatively boring businesses, but still growing at 7 to 8% per annum on P's of 12 and 13, 12 months ago. you know, if those companies were selling toothpaste, they'd be on P's of 24 times. So, you know, we thought, you know, that's oversimplifying our case, but just to illustrate that we thought they were very, from a pragmatic value perspective, quite cheap. So that cluster did very well. And the internet stocks, now you might think, well, that's a bit strange. You own, you know, you've got a big cluster of internet stocks. Well, you know, coming into this, you know, companies like Facebook, or software companies like Microsoft, you know, they weren't, we think, expensive for the growth that they were generating, and they've proven to be quite resilient, you know, business models. And our Chinese versions of those companies, like, you know, Alibaba, similarly have behaved quite defensively. And, you know, ironically, COVID has given them tailwinds. And you could argue in some of the healthcare exposures we've had, you know, we've also gained tailwinds from COVID-19. Now, the bad news, some of the more cyclical parts of the portfolio obviously have underperformed. They were cheap coming into this. They were somewhat already priced for a recession, and they've gotten cheaper in this big, you know, unwind of value. And that's the interesting thing about this year. In some ways, it's just a continuation of last year, but with more volatility. Investors continue to crowd into momentum, growth, high PE, and are not really interested in more cyclical parts of the market. They just keep getting cheaper.